Hello everyone, Rahul, Shah here, trying to make investing accessible and profitable for the average investor. Imagine you have some money and you want to buy a stock. Now, how you decide to use that money can be like investing, speculating, or gambling. Now, a super smart money manager named Joel Tillinghast had some cool ideas about this. Joel Tillinghast was a famous market beating fund manager in the US. He came up with an interesting framework to tell the difference between smart money moves and risky ones. He had a chart or a grid, if you will, to explain it. Now imagine you're trying to decide where to put your money. Joel said the best way to make your money grow is called investment. For it to be an investment, you have to do two important things. First, be a super detective, that is, do a thorough research. This means you really dig deep and learn everything you can about where you're putting your money, like finding out all about a new phone before you buy it to make sure it's good. Point number two, think long term compounding. This means you plan to invest your money for a really long time, like watching a tiny seed grow into a big tree. Over time, your money can make more money, and then that new money makes even more. Now, if you don't do both of these things, Joel said it's not truly an investment. He also had other ideas. Shrewd speculation. What if you do a lot of research but you're only hoping for a quick win, like betting on a short race? Joel called that shrewd speculation. It can be clever, but it's not a true investment because you're not planning to keep your money there for a long time. Then there's reckless speculation. If you don't do much research and you're just hoping for a quick win, that's reckless speculation. It's like buying a mystery box without knowing what's inside, hoping for something valuable, but it could be nothing. Next, risky investment. What if you don't do super thorough research, but you still plan to keep your money there for a long time, hoping it grows over many years? Joel Tillinghast called this a risky investment. It's risky because you did not do all your homework. Finally, gambling. This is when you put your money down without any research at all, just hoping for luck, like flipping a coin. Joel said that's plain and simple gambling. I think Joel's chart is pretty good at helping us understand these different ways of buying a stock. But there's one thing I don't totally agree with him on. He said you have to do super duper thorough research for something to be a real investment. But I've seen many times where people made lots of money even without doing all the research. And sometimes, even when people did tons of research, they still lost money. Think about Warren Buffett, another super duper famous investor. He's made billions, but sometimes he's made big money decisions in just a couple of hours. He didn't always spend weeks and months digging through every single detail. He just needed to see that the company was really good and that he could buy it for a fair price. He even said that some of his investments, where he worked super hard and spent lots of time researching, did not turn out well. So, thorough research can be a tricky thing. It might be helpful to do some research, but it does not guarantee you will win. I actually prefer what another smart investor, Ben Graham, used to say. He had a simpler way to tell the difference between investing and speculating. He mostly spoke about only two categories, investment and speculation, and left out gambling. He said it's an investment if you put your money into a company that is strong and healthy, like a sturdy tree, and you can buy it for a much cheaper price than it's really worth, like getting a cool mobile phone for half the price. That extra bit of cheapness is called a margin of safety. Now, if the company is not strong or you're paying too much for it, then it's more like speculation. Sometimes you don't need to do super deep research to know a company is strong and cheap. If it has a good history of making money and is selling for a low price, it can be pretty clear. Other times, you might need to do more digging to figure it out. And that's okay. For me, it's more about how strong the company is and how good of a deal you're getting when you buy it. It's less about how much research you did. Now, Graham's approach implicitly acknowledged that thoroughness in research can vary. There are indeed times when the intrinsic value of a company and its attractive valuations are so obvious that extensive deep dive research becomes less critical. If a company has a robust and stable financial history, a proven business model, and is trading at a significant discount to its inherent worth, the decision to invest can be relatively straightforward. The research in such cases might be more about confirming these undeniable facts rather than finding hidden complexities. However, in other scenarios, a more exhaustive research effort is indeed necessary to determine the true value and potential of a stock. This might involve delving into intricate business models, analyzing competitive landscapes, forecasting future earnings, or understanding complex industry dynamics. Both ways of checking things out are perfectly fine. You just pick the best way depending on the situation and what you're looking at. Therefore, the crux of the matter, in my view, should be less about the volume or intensity of research and more about the soundness of the underlying company and the attractiveness of its valuation. These are the truly defining characteristics that separate a prudent allocation of capital from a gamble or a precarious speculation. Let me know what you think. This brings me to the end of today's session. I'll see you again next time. Goodbye and happy investing.